In this video, we are going to be working with cash dividends, cash stock dividends, and stock splits. And we're going to be working with ACell Wireless. And once again, if you have questions, feel free to give me a call or email me and I'll get back to you. ACell Wireless needed additional capital to expand, so the business incorporated. The charter from the state of Georgia authorizes ACell to issue 50,000 shares of 10% $100 par value cumulative preferred stock and 110,000 shares of $1 par value of common stock. During the month, ACell completed the following transactions. So let's click here to see what they have. Okay, put it right here. Okay, so they've got all these transactions, and I'm not going to read them all, but once we get to it, I'll read the ones that we're going to be working with. So requirement 1, we're going to record the transactions in their journal. We're going to, like always, do our debits first, our credits, and then submit our explanations. On October 2nd, they issued 18,000 shares of common stock for a building with a market value of 110,000. So like the other homework problems we've been doing, we've mostly been issuing common stock or some form of stock in exchange for cash. And I think we did have one for a patent. So in this case, we bought a building, but instead of paying the building in cash, we gave the seller common stock in the business. Since we are getting a building in return for that stock, we're going to debit building. And the building has a market value of 110,000. Since the building is valued at 110,000, that's what we're going to record for the building. Okay. Our credit will be common stock for $1 par, because that's what it is right here, $1 par common stock. And since we issued 18,000 shares, that's times 1 equals 18,000. And like I said before, when we have excess, and which we do, it will be paid in capital in excess of par for common, because we issued common stock, for that difference. So what I'm going to do is I'm going to take 110,000 minus the 18,000 to get 92,000 for my paid in capital in excess of par. And that should be good. Oops, sorry, forgot the description. It's very, very picky. So we issue common stock for a building, and there we go. Okay. All right, so we debit building, and we record our issuance of the common stock. So we got the building in, we bought a building for 110,000, or it was valued at 110,000, and we issued common stock for that building. We have to record the par value, which is 18,000 because it's 18,000 shares, and then the paid in capital in excess of that par is 92,000. Our next transaction is we issued 550 shares of preferred stock for $120 per share. So this, we just basically issued it for cash. So cash is coming in, so we're going to debit cash for that amount. And we issued preferred stock for $120 per share. And the share for, not the share, but the par value for preferred stock is $100. So we are going to record the preferred stock 100 par value and we're going to also record a paid-in capital in excess of the par for the preferred because it's valued at 100, but we sold it for 120. So let's get our calculator. And we issued 550 shares for $120. So that's 66,000. And our par is $100 par, so I'm going to take 550 times 100 for my par of 55,000. And my paid-in capital in excess of par, or the over amount, is taking the 55,000 from the 66,000 equals 11,000. And my description is going to be issued preferred stock for cash. And that's how you do that one. Okay. So once again, we issued preferred stock for cash. We're getting cash in, and cash is an asset. So to increase an asset, we have to debit cash, record the preferred stock that we issued at par value, and the excess also is recorded because we sold it above par, and that's an 11,000 excess for that transaction. Our next item on the list is going to be we issued 14,000 shares of common stock for cash of 70,000. So it's going to be the same transaction, except that in here it'll be preferred stock and our par value is a little different. So once again, we issued it for cash. So I'm going to debit cash. And it was 14,000 shares at, well, basically it's just 14,000 shares for 70,000 and didn't give us an amount. So we'll put 70,000 here. And we issued common stock. So because common stock is $1 par, we're going to go in here and, oops, there we go. And because it's $1 par and we issue 14,000 shares, we know that this is going to be $14,000. It's only $1. So $1 times 14,000 is 14,000. And basically then we will know how to record our paid-in capital in excess of par for the common. And that would just be the difference between the debit and the credit. So I'm going to take my 70,000 minus my 14,000 for an excess of 56,000. And my description will be issued common stock for cash. Okay, next. They declared a $13,000 cash dividend for stockholders of record on October 20th. Use a separate dividends payable account for preferred and common. Okay, so we're going to record the liability at the date of declaration. So remember that when they declare dividends, we have to create that dividend payable account and reduce retained earnings. In a way, we're putting that money aside from retained earnings to pay this dividend. So retained earnings has a regular credit balance. So to reduce it or take away from it, we are going to debit retained earnings. And it's for 13,000. So that's what I'm going to put in here. And they said to use a separate dividends payable account for each common and preferred. So I'm going to go in here, dividend payable for common and dividend payable for preferred. Okay, remember my earlier example, homework example of the dividends, cash dividends for preferred and for common stock? Well, we're going to incorporate some of that into here. So here our preferred stock is cumulative, and cumulative once again means that if dividends, total dividends for that year was paid out and all of the preferred, and let's put preferred first. And if all of the preferred was not satisfied, they have to satisfy the amount in arrears in the following year. So just to keep that in mind. But earlier I had an example. I'm going to put this back up. And let's put it right here. Okay. All right, so preferred is 10% and it's cumulative. So what I'm going to do is to be able to allocate this $13,000 dividend payout is I'm going to allocate to preferred first, and then the rest goes to common. So preferred is at 10%, so I'm going to take 10% times $100 times, and I'm going to multiply that by the number of shares that we issued. So what you're going to have to do is go back to the preferred stock here, and we issued 550 shares, and I believe that's the only time we issue preferred stock. Yes. So what I'm going to do is I'm going to go back into my Excel and I'm going to multiply that by 550 shares. Yep. And my amount to allocate to the preferred is $5,500. Then the rest goes to common stock. So see what I did here? Okay. I took 10%, which is the 10% for cumulative preferred stock. It's paying out 10% dividend on the number of the par value, which is 100 par, and we had 550 shares issued so far, okay, which equals then 5,500, and the rest then goes to common stock. So I'm going to take 13,000 because that's the total amount of cash dividends the company is issuing, minus the 5,500 that was allocated to preferred stock, and the rest, which is 7,500, goes to common. And that is my declared cash dividend. And we are good. And the next one. On the 25th, then we actually paid the cash dividend. So on the date of declaration, we declared or created a dividend payable account, which is a liability. We put that aside from retained earnings. So on the date of payment, we are going to reduce those liability accounts that we created. So I have to reduce preferred stock or dividend payable preferred for that same amount that I declared. And I have to reduce the same amount that I declared for the common. Then I'm going to reduce or credit my cash for that total amount of $13,000 for the cash dividend. And that's paying the cash dividend here. We know we paid it because cash is reduced. And that's how you do that one. Okay. Next, what we're going to be doing is prepare the stockholders' equity section of ACell's balance sheet at October 31st, 2014. Assume that ACell's net income for the month was $91,000. Okay, so our paid-in capital, and if you look at an example in the book, it'll show you an example of how it's supposed to look like. So the first line that goes here is going to be let's see. Oops. My preferred stock at 10% 100 par value. Okay. And okay, so hopefully I'm putting it in the right boxes here. It's $100 par value. Oh, that's $100 par value. Oh, never mind. This is just the amount of shares that, oh, yep, it's already up here. So the amount of shares that we issued so far, which is 550 shares. Oops. It's 50,000 shares authorized. Okay, up here. I found that up here because they're authorized. You have to always state how much they're authorized to issue, and then that's 50,000 shares authorized. And 550 shares issued and outstanding. Okay. And what you're going to do is you're going to go back up to your journal entry, and you're going to go look at this amount here, the 550 shares for preferred, for 55,000. Okay, right here, 55,000 at $100 par. All right. And once we have that, then we could go in, and right here is paid in capital in excess of par, and that's going to be this amount right here, this 11,000, because that's the amount that was paid in excess of the $100 par value, and that is 11,000. Yep, 11,000. Good. Next, we've got common stock, $1 par. We are authorized to issue 110,000 shares authorized. And so far, how many shares do we have outstanding, issued and outstanding? We issued 14,000 shares here for common stock. And we also issued 18,000 shares here. So take all your transactions for how many shares you issue for common, which is 18,000 here. And one more, we also issued 14,000 shares here. And I think that's it for common. Yes, that's it. So a total of 32,000 shares issued and outstanding. So now that I went through and took each of my transactions up here for common, I took the 14,000 shares. Now I have to go in and add these amounts together. And since the par is $1, it's pretty easy to determine that par. If we issued 32,000 shares and it's $1 par, it's going to be 32,000 here. That's pretty standard there. But the excess here, same concept as what we did for preferred, paid in capital in excess of par for the common. I'm going to go back up to those transactions that we did for common when we issued them. And I'm going to add this paid in capital in excess of par for 56,000 here. And also, we did another transaction for common up here for the building. And I have to add in the 92,000. Only the 92 because we already added the 18,000 earlier of 148,000. When I said we already added the 18,000, that means it's in here. This 32,000 is the 18,000 plus the 14,000. Okay. Like I said, they were pretty easy. It's only $1 par, so however many thousands of shares you issue, that's how many thousands of dollars you're going to have here. So our total paid-in capital is going to consist of all of these numbers added together. So I'm going to take 55,000 plus 11,000 plus 32,000 plus 148,000. And that should be 246,000 for total paid-in capital. And my line here is going to be my retained earnings. And remember how we calculated retained earnings in Accounting 1? Hopefully they taught you. Let's see here. The reason why they gave us the net income is to calculate retained earnings. So what we're going to do is, they didn't give us a beginning retained earnings. So what we're going to do is we're just going to take this whole net income of 91,000. Okay. And to calculate retained earnings, we have to go back and look at how much cash dividends we paid. So go back to our transactions, and we paid $13,000 in cash dividends. So to find my ending retained earnings, I'm going to subtract that. And my retained earnings should be 78,000. So once again, they gave us the net income for the month of 91,000 here. We paid cash dividends of 13,000. So my retained earnings is going to be 78,000. In the prior chapter, partnerships, this 91,000 would have been our income, and this 13,000 would have been our withdrawals. So just think of the dividends as withdrawals. Okay, except that corporations have shareholders and partnerships have partners. So the partners' dividends, let's say, would be considered, the partners' withdrawal would be considered dividends to corporations. So that's 78,000 there. We'll put that in here. And my total stockholders' equity then would be that 246 plus the 78,000 for a total of 324,000. And we're all good. And that is how you prepare the statement of the shareholders' equity or stockholders' equity section. This is just a tad, the bottom part of the balance sheet. So there you have it. And once again, if you have questions, make sure to email me or call me.